There is a moment when the mathematics stop being theoretical and become violent. A moment when the leverage that created paper fortunes transforms into a liquidation engine that destroys real wealth. That moment is not a random accident. It is a pattern. A 7-stage sequence that has repeated throughout financial history. And right now, in 2025, we are in stage 5. Welcome to Wealixon, where every story reveals how money, power, and history shape the world we live in. Here, we uncover the patterns behind inflation, crashes, empires, and the lessons they left behind. Today, we are going back to the origin story of modern financial collapse. Not to 2008, not to the dot-com bubble. We are going back to the mother of all crashes. It is a ghost returned. Let me take you back. The year is 1920. The Great War is over. America stands triumphant, a creditor to the world for the first time. But peace brings its own problems. The industrial machine built for war is now idle. Demand collapses. Unemployment spikes. It's a sharp, painful recession. And then the intervention. The Federal Reserve, a young institution still learning its power, makes a fateful decision. It slashes interest rates. By 1924, money is almost free. And this is where our story truly begins, at the birth of a dangerous idea, that you don't need to save for the future anymore. Imagine it. For the first time, the average American can walk into a showroom and drive away in a new car, not with savings, but with an installment plan. They can buy a refrigerator, a radio on credit. Consumption is untethered from income. The entire psychology of a nation shifts from patience to immediacy, from saving to borrowing. But this is just the warm-up. The real action moves to Wall Street. And here, they invent the original financial weapon of mass destruction, buying on margin. Let me tell you a story to make this real. Picture a man, let's call him Charles. He's a shopkeeper. He saved $1,000, a decent sum, in 1927. He walks into a brokerage, buzzing with energy. The broker doesn't see a shopkeeper, he sees a mark. He tells Charles that $1,000 is a good start, but why think small? Use that as collateral. I'll lend you $9,000 more. Now you can buy $10,000 worth of stock. Charles is hesitant, but then he sees it. If our CA stock goes up just 20%, he doesn't make $200. He makes $2,000. His $1,000 becomes $3,000 overnight. A 200% return. The math is intoxicating. The danger is invisible. Because if our CA falls just 10%, his $10,000 position is now worth $9,000. The broker's loan is $9,000. Charles's entire life savings, his $1,000 is gone, wiped out. And if it keeps falling, it's a leveraged bet with your life savings on the table. By 1927, this isn't just Charles's story. It's the story of America. Margin lending explodes from $1 billion to over $8 billion. To you, understand the scale. Imagine today, with a $28 trillion economy, there was over $2 trillion in margin debt. That's the frenzy we're talking about, but the insanity goes deeper. It's not just individuals borrowing. Brokers are borrowing from banks. Banks are borrowing from corporations. The entire system becomes a house of cards, each layer dependent on the one below it. And here's where the story gets truly wild. There was a place called the call money market. This is where brokers went to get the cash they lent to people like Charles. And in 1928, the interest rates in this market would sometimes hit 20% for an overnight loan. Why would anyone pay that? Because they could lend it to speculators like Charles at even higher rates, and Charles would pay because his stocks were rising 50% a year. This is the logic of a bubble. Borrow at any cost because the returns are infinite. Until they aren't. This is stage 1 of the pattern. Easy credit creates artificial prosperity. A financial carnival where everyone is borrowing to speculate and calling it genius. Now, let's talk about the smart money. Because in every bubble, there are those who see the cliff's edge. One of them was Joseph P. Kennedy, the patriarch of the political dynasty. He was a master speculator, a man who ran pools to manipulate stock prices. But by the summer of 1929, he was getting out. The famous, and probably true, story is that he decided to sell everything after receiving a stock tip from his shoeshine boy. When the shoeshine boys are giving advice, he realized there is nobody left to buy. The greater fool theory had run out of fools. Kennedy understood the mathematics of doom. He knew that when everyone is on 10% margin, a 10% drop doesn't just cause losses. It triggers a mechanical, unstoppable cascade. Margin calls, forced liquidations, fire sales, a death spiral. So, he didn't just sell. He started building short positions, betting against the market. He wasn't trying to warn people. He was positioning himself to profit from their ruin. He wasn't alone. Bernard Baruch, another legendary financier, was also cashing out. He later wrote that he could sense danger in the very air of Wall Street. The confidence had become a recklessness that reminded him of every bubble he'd ever seen. The insiders, the corporate executives who knew their companies best, were secretly dumping their shares in massive quantities, all while telling the public that business had never been better. This is stage 3, the smart money exits. The warning signs flash, but the crowd, drunk on paper gains, doesn't see them. Which brings us to the peak. September 3rd, 1929. The Dow Jones closes at 381.17. The atmosphere is pure euphoria. People are quitting their jobs to trade full-time. The market is a national obsession. But beneath the surface, the real economy is already sick. Corporate profits peaked months ago. Factory orders were down. The stock market was a rocket ship. This is stage 4, prices detach from reality entirely. They rise on a collective fantasy, a new era, thinking that claims the old rules of economics are dead. What followed was, of course, the great crash, but the crash wasn't the event. It was the symptom. The disease was the leverage, the debt, the speculation that had been baked into the system for a decade. The mathematics became violent, just as they always do, and this pattern, the 7-stage sequence from easy credit to forced liquidation, has repeated with terrifying consistency. In Japan in 1989, in the dot-com bubble of 2000, in the global financial crisis of 2008, the technology changes, the assets change, but the human psychology of greed, fear, and leverage remains the same. Which is why, if you understand this pattern, you can see the shadows of 1929 in our world today. The explosion of margin debt, the speculative mania in certain assets, the "this time is different" narrative, the mathematical certainty of what happens when leverage unwinds. This is the mission of Wealixon. We don't just tell stories, we connect the dots. We show you how the patterns of the past are playing out in the present, so you can see the future more clearly. If you want to understand what comes next, if you want to see the economic and political forces that will shape the next decade, then you need to understand the patterns. Subscribe to Wealixon. Because in a world of financial noise and propaganda, we give you the signal. We give you the context. We give you the lessons that history left behind, so you can navigate what's coming. Don't just watch history repeat. Understand the cycle. Subscribe now.